Thanks for having me here, Austan.
Yeah, thank you for joining us to the beating heart of the Federal Reserve System, the Federal Reserve Bank of Chicago. I'm just happy I didn't wear the same tie, so that's almost the same tie.
Close, it's close. I'm glad I didn't either. I mean, I have 3 of them. Anyway, they've given me some questions here, and they've highlighted them in yellow, because I don't really know what questions to ask. I don't know. But they've given me, thank you. So the first one is the role of a central banker. I don't think we need to answer that question, do I? You want to answer that question? It says here,
maybe,
can you talk about the role of a central banker?
Regional, a reserve bank president.
Well,
let's interpret it that way.
How about this?
The role of central banker is to study, to sniff. As I say, I never aspired to be a bird of any kind. I only ever wanted to be one of the data dogs and sniff, sniff, sniff. You know, that's one of the first rules of the central banker is get the through line, try to figure out the through line. When setting monetary policy, the worst, maybe not the worst thing, but a bad thing it could be is just whatever happened last month, then we're going to adjust the policy. But the reserve banks, it's worth remembering, it's been emphasized by President Kashkari in Minneapolis before. The United States attempted to set up a central bank 3 times, and it failed twice. And the reason it failed was in very much the American people are not that comfortable with a centralized authority coming from Washington, D.C., without input from the rest of the country. The one that worked was when they set up the Federal Reserve Act, which has a heavy regional component that gets input from the rest of the country. And I think that the reserve banks, presidents, are key. That federalized structure is critical to Fed independence. And we care about our districts. As you know, we're heart of the Midwest here. We're more agriculture, more manufacturing intensive than most places. We're by far the highest auto production. And to the extent that manufacturing is one of the most cyclical parts of the economy, there is a lot of attention on the 7th District as canary in the coal mine. Where are we in the business cycle? So we're very operational oriented. In addition to monetary policy, as you know, the Chicago Fed, all the reserve banks, we're running payments. We got a giant cash vault with tens of billions of dollars in it, and we're running money in and out every day. We're doing something like $5 trillion a day of payments, wired transfers on FedWire, ACH payments, and we're out in the community as well as supervising banks.
Let me ask you a question about the federalized system, because one of the things I've done recently is St. Louis has a list of dissents, and you recently dissented, Jeff Schmidt dissented. Why is it that when I look at the history, and it goes back to 1930, why do the presidents seem to be the ones dissenting against a looser monetary policy on what seems like a much more routine basis?
I don't know the part that it's always dissents on looser. I do think it's more dissents in general, and that's kind of what I'm saying with the regional feds is we're independent. We're coming in. We aren't government agencies. We don't work for the federal government in a direct sense. Our job is to represent and watch from around the country, and I think that independence. There's an important economic history paper that, separate from just how the voting goes, asks the question, have a bunch of the ideas that are now conventional wisdom of monetary policy, were their origins in the DC Fed, or were their origins coming from the thinking and the research departments of the reserve banks? And the answer is a lot of the innovation in monetary policy has come from the reserve banks.
1986, Marvin Goodfriend, writing from the Richmond Federal Reserve Bank,
Exactly.
talked about the need for transparency. Probably the most historic movement in our time. I remember because I just wrote about that paper a little bit. Talk to me about how the role of the central banker has changed in the absence of data. You guys, who is the guy in the House here? Is the person in the House who does your unemployment rate estimate?
Scott and plus team. He'll be here at lunch.
So,
oh, no, he's here.
Hey, man, so listen. So you know what they did?
It's a team, but yeah, there he is.
This was very, it was pretty cool what they did.
Yeah.
They didn't have the official data, so they went to all this other data that they kind of put in there, and it's not been off. It's not been bad,
it's
right?
Been
You
very
were 4-4 and 4.
It's been very on.
It's pretty good. So talk to me about how you put a blindfold on, have a couple drinks, and then get behind the wheel of a car.
We still stuck the landing. We still stuck it. But look, we did not create the Chicago Fed labor market indicators because the government shut down.
Right, it was there.
It just happened. We've been working on that for months because, well, for two reasons. But we like the U.S. government data are the best data in the world. Period. Full stop. We must have it. We, the United States, must get that data, and it's the best. And part of the quality is it takes a while to get it. And we want as real-time measures as we can get. So we started working on a prediction, a more real-time prediction of what will the next unemployment rate be, as well as get 11 different data sources and make estimates of the hiring rate for people that are unemployed and the layoffs and separations rate for people that have jobs. Because those flow-based measures are, in my view, very good indicators of where you are in the business cycle. They're very informative. We released it just as the lights went out, and it was like, hey, if there's not actually going to be an unemployment rate, we can at least lean on what do we think it was going to be. And now when they've come back and looked, our estimates were quite accurate. And so one role of central bankers at any time is to get as much information as you can, because you got to get the through line. And the hardest thing that the central bank has to do is figure out the timing when there's moments of transition, or figure out, is this a moment of transition? Are we going into a recession? Are we strong and stable? And they've done a great job with these labor market indicators showing you can enhance what we know with supplementing private sector information with public sector and official information, and you can do it in a way that's real time. But don't anybody kid yourself. As good as our indicators are, and I recommend it, if you're interested in that sort of thing, go follow them. Everybody's data relies on the BLS
I'm going to make your point.
I
want to make your point now, which is that what we found in this shutdown is that there's a lot of alternative private sector jobs data.
Yes.
What there ain't is private sector price data.
Yep.
We used price stats, but nobody is out there. It's probably the purest form of a public good. There is no upside in telling somebody, hire an army of people that go out and go to Walmart and
that's literally what
actually, I happen to know
BLS
it's true
does.
that Walmart, I think, sends the data to the government electronically, but you know what I'm saying, is that and so that's what's interesting to me, is that everybody has decided, and let's talk about current policy now, which has decided that they're going to make a play based on what they think they know about the jobs market, which is pretty considerable. But nobody knows anything about what's going on with prices.
I expressed nervousness. It's true. We cut again. I supported the cuts in the previous two meetings. The data went blank, especially on the price side. And the inflation rate has not been great. After a couple of years of progress, it's still the case that we've been 4.5 years above the 2% target. We were making progress over much of 2024. The last 6 months plus, we've made no progress, and it's inched the wrong way. And right before the lights went out, if you looked at services, inflation was 3% for the first half of the year, and the last 3 months before the lights went out, it was 3.5%. That's not ideal, because that's probably not coming from tariffs. And historically, that's been a pretty persistent component of inflation. And so my dissent was rooted not in being a hawk, because I'm not. Over the next year, I still think, as I have thought for some time, that if we can just get the dust out of the air, fundamentally, rates can go down a fair amount from where they are today. It's just that front-loading the rate cuts when you don't have information and inflation's already higher than the target for 4.5 years, you got a couple of disturbing readings. And when I'm out talking to people in the district, one of the biggest concerns they're expressing everywhere is the prices are too high. The inflation is disturbing. I don't think it was much risk. It would have been much risk to just wait a little bit, small amount of patience, wait till Q1 of 2026. We're going to get a whole bunch of information. You know, I always say with data, 1 month is no months. That 1 month is not a trend. So you need more than that. But I'm going to make an exception for this month, because this 1 month is 3 months. We're going to get 3 months of data in 1 month.
I said you should cancel the meeting, but nobody listens to me.
You want to move it to Christmas. He want to move it to Christmas.
I'm like, what are you guys afraid of? A couple change fees on your plane tickets?
We're going to get a couple of pieces. We're going to get a couple of pieces.
You didn't want to spend the money on the plane tickets.
Don't point at me. It wasn't me.
What's that, Diane?
They already made their vacation.
No,
I know they made vacation plans, right?
So here's my thing. We haven't gotten information. The last information we saw right before the lights went out wasn't great, but it might have just been a blip. We're supposed to get, if you believe that the inflation we've seen is almost entirely from tariffs and will be transitory, that's supposed to start showing up in the data in Q1 of 2026. If you feared that the labor market was going to fall apart so rapidly that you can't just wait 6 weeks or a month or two to get the data, I would understand it. But my read of the job market is not that. It showed a little weakness, cooled modestly, but most of the measures have been stable. And a lot of the measures are at levels that have characterized normal expansion times, strong labor markets. The hiring rate is low, but the layoff rate is also extremely low. And that's not, recessions don't have low layoff rates. That you don't see unemployment claims going up, that you don't see the layoff rate high, that you see the job openings rate actually rising, and its level, I think, is around what it was last in a strong job market. Those gave me at least enough confidence that I felt the wiser decision would have been, let's just wait. I'm not saying that it means we have to not consider cuts for a long time. I just want to be sure that inflation is actually coming down.
Let's talk about the labor market. And I've remarked before that I don't remember a time when there's been so much of a challenge in terms of understanding what's happening on both sides of the mandate for the Fed. And I think you have this challenge on the inflation side,
been a while,
trying to understand the impact of tariffs, and this challenge on the labor side, which it kind of blows my mind a little bit when I think about what we call the 95% confidence level.
On
Think
what?
about what on the payroll number.
On the payroll
Think
number.
about what could happen if 120,000 is the 95% confidence level on a monthly payroll report, and we've downshifted to a zone where a normal number to keep the unemployment rate steady state is 40.
Yes.
It means I could do minus 80, and what would be my conclusion? That we're within the 95% confidence level.
We think the margin of error
is
like 105, 110,000 a month. So
tell me what Steve Liesman says on CNBC.
He says
if
too
the number,
much. He
no,
says, Steve,
no.
what
if the number
yes.
comes out,
you're going to get a lot of minuses.
At minus 80,
you're
what do I
get
say?
A lot of minuses.
What do I say? The job market's falling apart, or this is normal?
No, exactly. And that's that's
I think I say this is normal statistically.
That you can't reject that it's not normal.
You can't reject. Right.
Yeah.
That's the statistical correctly what I say. Yeah.
So here's the thing: something that's plus 40,000 plus or minus 105,000, you're going to get a lot of negatives. If you ask it a different way, how long? If it truly were, and I asked this about inflation too, how long would it take you, given the variability of the monthly number, how many months of data would you need to get to tell the difference between inflation that was 2.0 versus inflation that was 2.2? And I think the answer is years and years. You'd have to get so many, because it's so variable, it's hard to reject.
But stick with the job market for a second, because I do want to understand
one sub-note.
Yeah.
That's one reason why I like getting out and talking to people in the district.
Yeah.
Is that information is more real time than are we really going to sit here and wait for a year to find out whether inflation has fallen for a year? There are ways in which you can't afford, you have to make some decisions even though the data are uncertain.
But I want to get back to the steady state run rate, which is
of payroll.
Of payrolls, which is,
okay.
And this is, frankly, I've got to figure out how to do this.
I'm cautioning you. Don't do that. Don't do that. Because that is the one number that is the most uncertain right now. And we didn't come to that as some theoretical project. We came to this view from the experience in 2023 and 2024. Okay, that was an experience where, you'll remember, we're getting monthly jobs numbers that are very high, astoundingly high. It shouldn't be happening. How can we have 150,000, 180,000 a month job creation without generating inflation, with the unemployment rate rising, while we're putting up 150,000 a month and the unemployment rate is rising? And looking back, we realized it's because there was a massive amount of immigration that we weren't seeing in that moment. So the break even was just a lot higher than what we thought it was. And we predicted before we started to see it, hey, if there is a slowdown of immigration, you're going to see this happen. You're going to see the monthly payroll go down. And that's just in the same way 180,000 a month was not a sign of overheating. 40,000, 60,000 is not going to automatically be a sign of recession. And we learned in 23 and 24 that the rate-based measures, the unemployment rate, the vacancy rate, the hiring rate, those rates were a better indicator of where you were in the job market. In the business cycle, part of the job market, than was monthly payroll. So again, I'm going to caution you, Steve, don't just jump all on the monthly payroll. In our old days, that's the one tent pole number, best number we have. But in a world where we're not observing the payroll, we're getting big revisions of the number as time goes by. Then the QC, we might have zero. All of these things, you'll never hear me say throw data away. Just don't get so over-indexed on that one number, because that's the one job market number that has pretty significant question marks around it.
Yeah, I agree. And I'm, it's the way the market trades off it that sort of leads to that sort of engenders the press coverage in that.
That's probably
literally there are algorithms that are, before you can get the word out of your mouth,
hyped on
they've read the algorithm off the feed, and they've traded based upon where that number is.
And didn't they have some period where for this number, they try to get the physical location of where they get the information
closer?
Well, 100 yards closer, so that the nanoseconds.
Well, what's interesting about that, by the way, is if you think about it, the market never comes back to trade the truth.
That doesn't sound good.
The revision comes through. Now, it is true the last several months the market has been much more sensitive to the revisions. But before that, the only way to actually make money predicting the payroll number is to figure out a model that predicts the mistake that the BLS will make. It is true. But let me move on. Let's talk about what's happening in the region here. Well, and I'm going to ask that by way of also asking about the jobs numbers, which is, we always want to be afraid. The first thing I learned covering economics about causation and correlation. Since April of this year, the small business component of ADP, 1 to 49 workers, has shed 250,000 jobs since April. In the 7 months before April, the small business component increased by 250,000 jobs. You know what happened in April, right? So, and I will say that when these tariffs first hit, my biggest concern was not how big companies would deal with tariffs. It was how small companies would deal with tariffs. And I want to ask you about manufacturing in the Chicago area, but I wanted you to first address, if you don't mind, this issue of, are tariffs something that is severely hitting small business as far as you can tell from what you see in data and also anecdotes?
In the 7th district, we got 5 states. I'm prepared to believe that I was more heavily attuned to impact of tariffs on the economy than the median person, because this district and the people that I talk to are far, far more exposed to tariffs than anywhere else. There was a measure of exposure by state, and of the top 7 most exposed to tariff states, 4 of the 7 are in this district.
Really?
Number 1 was Michigan. I think number 2 was Indiana, because a lot of manufacturing, a lot of agriculture, and those are the 2 most affected.
But also close to the border with Canada.
And close to the border with Canada. I would characterize early March, April, May, a lot of people's hair is on fire about tariffs. If these are going to be the rates, we don't know what we're going to do, especially in autos. This is going to be devastating. I will say, as we've done some deals, found some exemptions, take the USMCA stuff, that cooled a bit. Some of the smaller companies, it was descending, and has descended into a dispute between the suppliers and the bigger OEMs, who's going to have to eat it.
Right.
And the deeper question now, I've been heartened that the overall impact of tariffs did not match the kind of the dark scenarios they were describing at the beginning. But this question of, is it done, or is there more to come, is a live question and varies by industry. So there are some industries that are like, this is a new settling point, we think it will be fine. There are others that say, we've been holding off, but if this is the true settling point of the tariff rates, now we're going to need to pass it on to the consumers. So that's got me a little concerned that the persistence of the tariff inflation may not be as transitory as the
How
forecast.
would you describe, this is a heavy manufacturing area here as well as agriculture, how would you describe the state of those two businesses right now, those two industries?
A pretty tough spot in both. So in agriculture, they've been squeezed. The sale price of their output has been pretty flat, and the cost of all the inputs has gone up. So farm income has been squeezed. In manufacturing, you had the double hit,
right,
which was in the pandemic itself, nobody could go spend money on services, so there was a heavy shift into goods. That was to the benefit of manufacturing. As we've come out of COVID and the budget shifted back to entertainment, hospitality, going out to restaurants, going on vacation, it's come away from manufacturing. So there was already this like secular trend downward. And then you add onto it, when they put in tariffs, they did not exempt intermediate goods, components, and supplies.
Right.
So costs have gone up. You've seen manufacturing employment's been having a tough spot. Yeah.
Okay, we're going to get to audience questions, but I do want to ask you the same question that was asked Carl.
Okay.
Which is, walk me through next year. And Carl's answer
that wasn't a question.
Well, it will.
That was a statement.
Carl's answer was 95% probability that we'll be up, higher, or the same.
In rates or in the economy?
No, he just meant he was joking. Pardon me. Which reminded me of a guy on CNBC once. We asked him what was going to happen with the market. You have to understand, the market is always in a position of horizontal, vertical consolidation.
We have a friend who became a famous doctor and is a professor down at the University of Chicago. But she started at the Wall Street Journal. Used to have this TV show, and she came out of college and she was working, and her job was to call the people up and say, you know, the price of copper is down. You know, the market reacted to something. Why? And she would get a quote. And they would come in, and there was something. You know, gold is up.
Right.
So they rushed it in, and then somebody said, wait, but gold is down, not up.
Yeah.
And so they said, call them back and see. And they called them back. Why is it? Gold is actually down. And then the answer was, same reason. And she said, I'm done with this. She went into medicine.
You know, I will say one thing, though, which is when I went from the Journal to CNBC, I looked down on the notion of the immediate commentary on what's happening.
Yeah. And now you make a living out of that. And a good one.
It's true. But what's interesting is you watch the market price to immediate data, and it's a lasting move.
And it's like
Doesn't go away.
They get it right on from the instant.
Immediately they price it in.
That's the magic of the market.
It's always a question as to whether or not, once you learn about something, has the change already taken effect?
Yeah, right.
If I come on TV as soon as Intel's or you know, NVIDIA's earnings are published, and I tell you within 2 minutes that they beat the street, the stock is already moved in that regard. That's another story.
Yeah, that's out of our.
It's out of our thing, but it is
we're not
interesting.
allowed to trade individual
me
stocks,
neither.
and we have to announce 45 days in advance if we were going to trade anything.
No, you're probably better
off. The answer to the Carl question, I'm actually pretty optimistic. My base case for next year is pretty optimistic. If we get in Q1 the evidence that we are back on path, inflation is coming down to 2%, we get the kind of stagflationary dust out of the air, the stuff that is raising prices and deteriorating employment simultaneously, I still think underneath there is a pretty decent, resilient consumer. Growth will be solid. Rates will be a fair bit below where we are today. But there's risks, and to me, a lot of the risks are that inflation, not just, it doesn't have to be just that inflation gets worse. if inflation just stays where it is and has been for the last 6 months, that's bad. That's a failure. The Fed will have a black mark on its record if we let inflation be pushing 3% with no improvement, and we didn't try to fix that.
Are you aware and factoring into your forecast this idea of a surge in refunds, tax refunds early next year?
I don't. There's refunds every year.
No, but the estimate
You
is that
think
they're
it'll
going to
be
be
more
$1,000
refunds
on average
because
higher.
of the tax cuts?
They made these tax changes like SALT and other things, and people did not adjust their withholding to expect that. And so there's a lot of estimates out there that there's going to be this surge in refunds at the beginning of next year.
Because people are going to get money that they didn't know.
That they didn't know was coming, essentially.
I think implicitly, yes, but I don't know that we spend a lot of time modeling, and we have Leslie here to tell us. On the fiscal side, historically, we're less on the psychology and more on the, what is the fiscal increment? If the deficit is getting bigger, the fiscal increment on GDP is going to be higher, and we try to think through the spillovers. And I think that there is going to be an increase in that fiscal stimulus, let's call it, if they added on top of it another big tax cut, which you've seen in Congress they have been discussing.
Right.
Then we would have to rebalance. But for right now, we've mostly just been going off of what the forecast is.
There's one more thing I want to ask before we maybe have time for one of the questions here, but there's a lot of talk, and I know because I lived through this, about whether or not the Fed ought to do what Greenspan did in '96. And I think Greenspan is famous for, one of the things he's famous is in '96, amid sort of higher or high-ish inflation, he decided not to raise rates because of what was happening on the technology side. And there's productivity.
Yeah.
And there's a call from the administration, not just the administration, but others as well, who say, you know, there's a massive investment in technology happening right now, and that will pay off in terms of higher productivity. And they're calling now for policy to adjust to that inevitability. How do you feel about whether or not right now you ought to think about you can lower rates without fear? Because
a year ago, I gave a speech out of Stanford that was about how should we think about the higher productivity growth that we've seen, and what does it mean for monetary policy. It's a little more complicated than just, hey, if productivity growth is higher, then let's make the rates lower. Because if you're a person who thinks about R star and what the settling rate is, if the growth rate is higher permanently, that actually connotes rates need to be higher, not lower. That said, I think that the high productivity growth has given us a little bit of wiggle room over the last couple of years that wage growth can be higher. Almost everything about high productivity growth is good. It means wages can be higher without generating inflation. But is it a dark side? There's a danger, which is counting on future productivity growth that you haven't seen yet. We've seen the beginnings of. But you tell me there's going to be a huge profitable increase in productivity, which goes into the valuations today. And the owners of these future productivity go start spending the money based on the wealth, stock market wealth that they've accumulated. Or there's huge current investment, physical investment, based on what's going to come. You just got to be careful, because you can overheat the current resources of the economy by doing that. And when you find, in a way, the 1999, 2000, the legacy of the 1996 decisions by the Fed are not as clear in that it might have fueled the bubble. And if you overload the bubble, and everyone starts consuming out of the wealth that they are concluding they're going to inherit very soon. And then you find out the growth rate of the internet is not 27% per year, but only 7% per year, which is still pretty good, but now you've overinvested based on that. And at some times of the night, the job of central banker is not to sleep at night, so I won't say it keeps me up at night. I'm not sleeping, but it does give you a little worry if you see the valuations going crazy based on future productivity. Do you want to fuel that, or do you want to push against that? I think that's a contrasting factor. We're trying to balance out things. Overall, in the short run, the faster is productivity, the more wiggle room it gives us.
Well, Greenspan actually addressed that question for what it's worth. And his response was, we will address the effect of the bubble popping and not try to restrain it ahead of time.
Okay. And we did have to do that. Now, that was a recession. The aftermath of the popping bubble was a recession.
Right.
So we just got to think about that. It's a long, almost quasi-religious battle about the question, what should central banks do if they believe there's a bubble? Should they just try to mop it up if something goes when the bubble pops? Should they feed the bubble? I don't know, but I do think that we got to think about all sides of this, not just the productivity.
It's feed a cold, starve a bubble, isn't that right?
Feed a cold, starve a bubble. Yes, maybe.
I'm just making that up. Maybe that's right. Okay. Well, I don't know why this one has 3 votes of all of the votes out there, but this is the one. I got this thing here. It says, do you think it would make sense to change the location of some of the regional banks? Parentheses, not Chicago. Since the population of the U.S. has shifted south. Could you open a branch in Florida? We could do this next year.
There is a branch in Florida,
no,
Miami.
For Chicago.
Oh, for Chicago? This like launch invasion. We'll just start taking some more of the states. We got it in Wisconsin. We have the bottom, like the southeast 2/3, and they got the northwest 1/3.
Who's they? Minneapolis?
Yeah, Minneapolis. I would say there is a kludgy nature to the location of the reserve banks, and I guess in 1913 they needed 2 senators' votes from Missouri or something. So there 2 of the 12 banks are in the state of Missouri. At that time, there wasn't anything in the West, so the San Francisco Fed now covers a massive share of the population. The only reason I hesitate to say, well, I don't think we should have a automatic, like it was a cost of living adjustment. We're going to keep moving the feds as population growth shift to Arizona. Should we, take the Kansas City Fed and move it, 50 miles to the southwest? The basic idea that we have representation of the whole country, I think, is extremely important. It was an inspired bit of genius, really, from the Federal Reserve Act. It's fundamental to the monetary and other independence that is embodied in the Federal Open Market Committee. I would really regret if they reopened the Federal Reserve Act just to rebalance.
Would they have to do that there?
I think they would have to do that there.
Yeah,
I'm not sure. It's a funny, with the Fed historian is half works for us and half at St. Louis Fed. And he gave me, at the time when they announced the banks, they did a poll of bankers. Where do you think there should be branches? And everybody made nominations, and they did a tour. They went around just kind of scoping out the sites. And the places that weren't chosen were furious, and they demanded to be represented. There are many branches. So we have a Detroit branch of the Chicago Fed, and I do think that, and those branches have boards too, so we get a lot of representation from business people and civic leaders in Michigan through the Detroit branch board. So I think it's a little, the question is a little unfair in that there is actually a lot of representation. It's just the headquarters bank is in these locations.
I think that's all the time we have. We were supposed to end at 10:20. Say again?
He wanted to go more. We're getting conflicting signals. Ask one more. Some are like, have you given us a signal? And
what
others
did
are
we
like,
talk?
yeah.
We talked
Okay,
about
what?
we talked about productivity. We talked about inflation. We talked about jobs. Let me ask you about independence of the Federal Reserve.
Okay. Oh, look at the time.
I have it on good authority. You have 2.5 more minutes.
Yes.
And we don't count the question time either. It seems as if the president has sort of challenged the independence of the Federal Reserve. How important is it for the Federal Reserve to be independent? And how much challenge do you feel to that independence?
Baseline, super important, the Fed be independent. Let me say what I mean by independence. I've only been at the Fed not even 3 years, but about 3 years. Before I was ever at the Fed, I was a research economist, 30 years at the University of Chicago. I and a unanimous collection of every economist that I know believes central bank independence is critically important, where independence means the politicians do not get to decide what the interest rate is. That's the nature of independence, that we set monetary policy based on the economic conditions without political interference in the setting of the interest rate. The reason they believe that, it's not I don't consider that a political statement. It doesn't need applause. It's not, but it's partly rooted in economic theory. It's partly rooted in economic theory, but it's partly just rooted in looking out the window. Just look at places where they do not have it, or times in the United States where we did not have it. It goes badly. It ends in tears. Inflation comes roaring back. Of course it does, because I was the mentee, great personal friend and mentor of mine was Paul Volcker himself, and I worked with him through the financial crisis. And when he passed away, his widow, Anka, gave me several of his things, one of which was the original 2x4 that they sent him. Then it's sprawled on it. It says, "Please lower these insane interest rates." And I keep it in my office right downstairs to remind me, the decisions that the Federal Open Market Committee makes matter to the world. It's not just an intellectual game. They matter, and sometimes the Fed is the one that has to do the difficult decision, the unpopular decision, take the punch bowl away, keep the interest rate. They must fight inflation. If you don't have Fed independence, inflation is coming back. If that doesn't bother you, then it probably wouldn't bother you. But that bothers people. Just look at the survey. That bothers people. I would like to get us out. It pains me that people are really legitimately saying, no, why should a group of people outside the government, outside the administration, be deciding the interest rate? They shouldn't be independent. You have had some even making the argument that the Fed should lower rates so that it will be cheaper to float the debt. That's the monetizing the debt. That's the canonical reason why you want the Fed to be independent. But I don't think, I'm pretty optimistic in this space, because I think everyone knows this. And at the end of the day, in the 3 years I've been there at the FOMC, I can't tell you how impressed I am. Everybody takes the job extremely seriously. You'll see the transcript will come out. You can read word for word what's on everyone's mind. You get a sense of it from the minutes. They come from very different backgrounds. They have very different worldviews, but everybody is there making the interest rate decisions based on the economy. How is it? What is the state of the economy? What is the economic outlook? And as long as the members of the committee retain this independent view and are committed to calling balls and strikes as they see it, the Fed will be independent.
So if I was on the Fed making jokes, it wouldn't be taken well. If I was like, you have to get serious, is what you're saying.
No, I'm not saying that. I'm the least serious person. When the transcript comes out, you'll see I'm not above telling jokes at the expense of other districts.
But not
but the decisions are based on content.
Please join me in thanking Austan for a great